Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about Sofi Technologies SOFI stock and why Wall Street professionals believe this company is about to surge around 60% over the next 12 months. After that, we're going to go into detail talking about Palantir's new collaboration and agreement with Integrity Mold and Tool, which will increase Palantir's overall revenue and of course be very good for the overall company's brand awareness. After that, we'll move on and we will discuss Mullen stock, ticker symbol MULN, and we will be referring to their electric vehicles and how the share price temporarily increased and has recently pulled back around 10%. And then lastly, we will go over why Carvana is struggling and why I think they are going to face very harsh criticism over the next few months and potentially have their share price drop as low as $1. So for more videos just like this one, remember to go and smash that like button right now, comment your thoughts down below, subscribe if you are new, and without further ado, let's jump right into today's stories. Sofi Technologies is a fintech company or a financial technology company that offers an all-in-one inclusive digital app which gives their customers access to various financial services and financial products. Right now, the current share price is trading at $4.42, while professionals believe the company is undervalued right now because it should be trading anywhere between $5 on the low end or $10 on the high end. Even Wall Street analysts have chimed in and said that there is too much pessimism around the stock right now, and they expect a big rebound for this stock coming soon. The consensus price estimate for this particular company gives Sofi on average around 59.6% upside over the next year, according to their current closing price. So this means that this company could technically be viewed as undervalued over the next year, and eventually, when the macroeconomic economy starts to fare better, we could see this company have a huge rebound, but you're just going to have to be very patient. Now, that is not a reason to buy more of this stock if you are already overexposed more than a 5% allocation to this company. If you already have over a 5% exposure to this company, there's no need to take on any unnecessary risk by increasing your allocation over 5%. In the meantime, just hold this company and wait for it to eventually rebound according to experts. But again, always make sure to do your own research. Sofi essentially runs an all-banking platform which is completely digital. However, there is softening demand for their various products and services, so it's easily understandable why their overall business has decelerated as of late. But throughout 2023, we are still anticipated to see strong growth numbers in both their membership as well as their overall revenues. On top of that, Sofi stock right now currently trades at just 37 times their adjusted EBITDA estimate for 2022, which is somewhat expensive, but considering their growth rate, which is above a 30% CAGR, we can see this company becoming very well valued over the next 2 to 3 years. That's why holding this company is probably good, even while the current macroeconomic environment is not being friendly to many growth and technology stocks. Therefore, Sofi has a great chance to grow its overall valuation and provide market-beating returns over the long run. That would be over the next 5 to 10 years and even beyond. So if you're willing to hold this company for that long and you're not overexposed to it, the consensus rating on this company is to hold until they have a rebound, which could be over the next 1 to 2 years, depending on the overall macroeconomic economy and environment. The next stock we're going to talk about is Palantir, ticker symbol PLTR, which is a big data and analytics company that is a leading builder of operating systems, and they have clients both in the commercial space as well as the government space, and they've recently signed a collaboration agreement with Integrity Mold and Tool, which I will just refer to as Integrity. Integrity essentially is a global pioneer in the tool and mold industry, and they recently announced a partnership with Palantir Technologies, which is a multi-year, multi-million-dollar partnership that will help and allow Palantir to optimize Integrity's overall business in terms of their scheduling, engineering, their product designs, and their overall sales, and of course, their ability to make informed data-driven decisions, which is going to be very beneficial for Integrity's leadership. The Integrity founder and CEO even had to say this about Palantir, and he says, "Thanks to our talented and hardworking team, we had extracted all the potential out of our current system, but wanted a more advanced data platform to reach our full potential." He goes on to say, Palantir Foundry is aligned with our desire to act with speed to push the boundaries of what is possible and will help take Integrity to a new level, end quote. On top of that, Palantir themselves believe that their software, referring to their Foundry software, will play a critical role in ensuring the overall job security of tomorrow's workforce. And their technology essentially aims to amplify and not replace human decision making. So I think that is very comforting to say, but even despite this recent development in this collaboration, we can see that the PLTR share price has fallen by almost 8% as of right now, because again, in my previous video, I think that Palantir, considering the current macroeconomic environment, is overvalued, and we could see this drop below or even as low as $5. So I would love to hear your thoughts on that. The next company we're going to talk about is a company that I am personally not a fan of and I don't own. Out of all of the companies on this list, I would say they're all extremely risky growth companies, and you really need to do your own due diligence and estimate the risk to reward for each of these stocks. Now, out of all of these companies, I would say SoFi is probably the best opportunity that we have here, but as we discussed, that currently has a hold rating until they have a rebound, which current analysts and Wall Street professionals predict. Mullen stock, on the other hand, is hyper risky, just like the next stock we're going to talk about, and Mullen is an electric vehicle company whose share price has recently increased and surged to just pull back around 10%, because right now it's trading at 28 cents per share, and they're a starter electric vehicle company. Over the last few months, we have seen a very ugly development in terms of electric vehicle stocks. That would include juggernauts like Tesla, as well as smaller starter companies such as Mullen Automotive, ticker symbol MULN. And it doesn't matter if you're a behemoth like Tesla or a smaller company like Mullen, all of these stocks are down right now. The main reason why Mullen originally surged in their share price from 19 cents up to around 31 cents and a little above that was because they were flagged as a potential catalyst or an opportunity to have or experience a short squeeze, and that's why the share price increased in just a 3-day stretch by a large margin. But now we're seeing a pullback in the share price, and that's why it's down more than 30%. So we could say, why is Mullen down 10% today? Well, like we said, it's a pullback, but ultimately the answer is the stock market is volatile right now. Even stocks like Tesla are not performing very well, so shares of electric vehicle companies, especially over the last few months, have fallen. Tesla, being the leader in this particular space, has even seen their share price tumble very low over the last 5 trading sessions. However, there's been no escaping the overall selling pressure in the overall stock market, because it's not like electric vehicles are the only types of stocks that are experiencing this weight of poor economic value creation. For instance, NIO and Tesla have both showed solid growth with streamlined production and delivery numbers, which normally would be a good thing, but because the overall macroeconomic environment, including the general stock market, is doing poorly, and due to NIO and Tesla being a part of the general stock market, this has pulled and weighted down like an anchor on NIO's and Tesla's share prices. So the recent volatility in stocks doesn't really have to do with these companies individually, but rather what the overall stock market is doing. Now, in this instance, I'm still not a fan of Mullen stock, but some investors do anticipate that Mullen is set to double their overall revenues this year to about $131 million, but analysts expect just an 11% growth rate in sales over the next year. Really quickly, we did see a nice sized order for Mullen's vehicles, particularly their electric vehicles, for around 6,000 cargo vans, but there is still concerns about the company's overall profit and loss perspective, because fundamentally, I don't think this company is a very wise investment. Why not wait for this company to either prove themselves or go out of business before you're taking on a giant gamble? Because we are investors, we are not gambling. If you want to gamble, go to a casino. If you want to invest, then stay tuned. But investing into these types of companies before they have proven themselves in terms of their risk to reward and their overall fundamentals is just extremely unwise. Moving on to our last company, that is going to be Carvana, which is really feeling the heat lately because their share price has fallen so drastically. Right now, the Carvana share price is trading for just $4.39, while professionals think the company should be worth anywhere between $1 on the low end and $50 on the high end. But why is the Carvana share price falling? This is different from why the NIO and Tesla share share price is falling because Carvana internally is doing very poorly. And Carvana's ticker symbol, of course, is CVNA, and it's already dropped by around 12.23%. So what's up with this? Essentially, Carvana is burning their overall value, and investors are seeing right through this, and that's why we have seen shares absolutely plummet. And this is not just mainly due to the economy, but rather they did something at an inopportune time, and I'll get into just what that is. Essentially, Carvana, if you didn't know, they sell used vehicles, and right now consumers can't afford to pay their car loans anymore, and this would go for both used and new vehicles. Due to inflation, high energy costs, and rising interest rates, this has made consumers default on a plethora of different types of loans, including their auto loans. So essentially, Carvana is now floating the bill due to a multitude of defaults on their overall used cars that they sold. And if the macroeconomic environment gets worse in 2023, like many economists and analysts predict, we could see Carvana going as low or even lower than $1. Essentially, right now, Carvana is burning a boatload of money, and they are going to have to sell and liquidate their overall vehicles to pay their overall debts. According to TheFly.com, a Wedbush analyst finds it difficult to see how Carvana could survive due to its liquidity problems. In a research note to clients, Carvana operated an acquisition of an auto auction house that was very quote-unquote ill-timed. So essentially, they took on too much debt, they made an acquisition that they thought was good, and then the economy took a turn for the worse, and now Carvana's resources are drying up to where they're going to have to sell a lot of their used cars, thus flooding the market, which means that used cars in the used cars market will go down in price. However, Carvana is going to be floating the bill for that because they're going to have to sell these vehicles for pennies on the dollar because they have to pay who they are indebted to. So this is looking very bad for Carvana. I think the share price is going to absolutely plummet. But on the bright side, used cars could actually lower in price due to Carvana injecting more supply into the used cars market, which is going to lower their overall price according to macroeconomics. So I would love to hear your thoughts on Sofi Technologies, Palantir Technologies, Mullen Automotive, as well as Carvana. Remember to go and smash that like button right now for more videos just like this one. Subscribe if you are new, and I will see you in the next YT video.